Berkshire Hathaway cutting stake in Apple to raise cash to a record high of $277 billion.
It's the highest levels of cash that Berkshire Hathaway has ever had. But it is an absolute war chest now of cash. You don't even need to have a recession. If companies just ratchet down their growth expectations by 1, 2, 3% on the top line, it can take the NASDAQ down another 10, 15%. Oh, that's a very big thing.
This past week has been marked by significant volatility in the equity markets. The NASDAQ continued its sell-off. It's now down about 10% from its peak in mid-July, July 11th. Is the peak in? We'll examine this issue with our next guest, Singh, who is the founder of Special Situations Research. He's going to be giving us his outlook on not just the markets, but also the economy, and giving us a few special situations to watch out for. Jay was previously a portfolio manager at Goldman Sachs before starting his firm. Welcome to the show. Welcome back, should I say. You were on the show a couple times last year. I encourage people to check out our prior interviews. You had some excellent insights on the special situations then, and we'll be updating us on the special situations now. So thank you for being back.
Happy to be here. Thanks for bringing me on again. There's been, a complete 180 degree, view on what's going on in the market since we last spoke. While earnings season has been relatively strong, what we've noticed is that companies are now selling off more than twice as much on negative news, and they're rallying, much less than they were in the last 7 earnings seasons when they post good data. You could even see that when, Amazon reported last week, they essentially met guidance, but the stock was down almost 11% intraday on a slightly weaker outlook. So there's quite a lot I think we can cover during this call. And one of the main points that I think everyone is concerned about is the very sharp drop in the equity market the last 2 days of last week. Specifically, we saw the NASDAQ drop almost 10%. At one point, we saw the Topix drop, I think, intraday close to 14%, the biggest two-day decline since May of 2024. I think it's been driven by a number of factors. And we've noticed that the consumer in the U.S. has been rather weak. If you look at retail sales, if you look at credit card data, it's really the lower end consumer that's been challenged, as pandemic savings is now negative $72 billion. It's all been spent, and the cost of living is still elevated. While inflation has come down, the cost of living itself is still 20% higher than it was pre-COVID. That's put pressure on people's savings. There's been a lot to do on the long side. A lot of defensive names, utilities have strongly outperformed. Tobacco stocks, like British American Tobacco, is paying a 9% dividend. That stock is up over 20%. There have been a number of merger arb names that have done exceedingly well. But on the broad stock market view, what we've seen is we've become more cautious, because not only is the U.S. economic data coming lower, you're starting to see economic data in Europe and China. China's been the biggest disappointment of this year, and it's really dragged the German economy lower. And we have, in reaction to that, we've seen the Bank of Canada cut 2 times already. The Bank of England cut last week, and now everyone's just waiting for the Fed. So after the FOMC meeting, we didn't get a cut in July, but I think there's an expectation now of a cut in September. In fact, after the steep market sell-off in the VIX going to 27 on Friday, there was actually at one point during the day almost over 50% probability of a 50 basis point cut in September, which I don't think is going to happen. So you can track that on CME Futures on their website. But to really dig into what's happening, I think what's not really being covered by mainstream media is the last economy with zero interest rates, essentially Japan. The Bank of Japan raised rates to positive 25 basis points for the first time in over 15 years. And why that's important is you really have to understand, what the yen carry trade is. And, essentially it's a strategy that involves, borrowing cheaply in yen, essentially at zero or negative for the past 15 years, and then buying higher yielding assets and currencies like the Mexican peso, right, which has a high single digit rate and buying assets using those proceeds. So it was essentially the cheapest way to borrow in the world. And it resulted in this carry trade and, huge amount of leverage in the system. What people don't realize is that a lot of the buying of stocks and real assets in the US is come from foreigners. So if you look at the developed markets, more than 2/3 of the flows from developed markets have been coming into US stocks and US real assets. And, as that carry trade unwinds, there's a lot of room for downside volatility in US assets. And the US market, right, essentially governs how other developed market and Western market equities trade. And you could see that in European Euro Stoxx futures, CAC 40 futures, FTSE the following day after a sell-off on Thursday. You also saw that in Asian markets. The U.S. market is actually 60% of world global market cap. So whatever happens in the U.S., tends to create a ripple effect. So this conversation is very important because the U.S. market is very closely tied into this yen carry trade. And I do think that it is currently unwinding, and it's taken a lot of people off guard. Now, there's a lot of sources of capital. There are sources that can buy into weakness. There's $3 trillion of dry powder in private equity. There have been firms that have been raising cash for the last 2 years in anticipation of a slowdown, but they're really more on the value side. They're not chasing growth, and that's why you've seen a lot of these NASDAQ names, fall so quickly, because a lot of the hedge funds that are now fully invested and CTAs that are overextended, they're not going to be allocating their dry powder until they can find deals. So you've seen companies like Nvidia's and High Flyers down 20%. It's funny, we have a group of almost 2,000 professional institutions in our educational Discord. We talk every day starting 4 a.m. in U.S. pre-market. And, we were joking around in our group last week that NVIDIA peaked, a couple weeks right after Jensen Huang, who's the CEO of NVIDIA, was over in Taipei at the Computex conference, signing a woman's breasts. And I was like, that is the top indicator if you've ever seen one. And since then, you look at all the names that are in that sector, the SMCI, of the world, the VRTs, the AMDs, they're all down double digits. In fact, the SOX index, the US semiconductor index, was actually down 8% in one day, which is the biggest drop I've seen in that index in the last couple of years. So I think it really shocked a lot of traders. It caught a lot of people off guard. And frankly, I don't think the volatility is over.
Before we continue with the interview, I want to tell you about another way you can invest your Bitcoins and store them safely instead of using a traditional wallet or an exchange. Consider an IRA. Today's sponsor, iTrust Capital, is one such IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1% only. And being an IRA, it also offers unique tax benefits. If you'd like to get started and learn more, click on itrust.capital/David in the link down below, or scan the QR code up here. If you're over 18 and you want to open a new account with cash or roll over an existing account, you can do so using my referral link. And if you use that referral link, you'll get $100 in signing bonuses. Okay, I want to come back to that. The volatility is not yet over. First, going back to what you said about the Japanese reversal of the yen carry trade. So I have a chart that I'll show for the audience. I'll put on the screen here. It's the USD versus Japanese yen. Blue line and the orange line is the NASDAQ. And you see basically a near perfect overlay year to date. Basically, as the yen appreciated, the NASDAQ fell and vice versa. So to what extent were Japanese capital flows largely responsible for the tech sell-off that we've seen this past month, and going back previously to the last quarter, contributed to the growth of tech stocks?
So it's not necessarily Japanese capital that's flowing in. It's investors that are borrowing in the Japanese yen. So yes, there is a lot of capital coming in from Japan in several ways. The big Japanese banks, Sumitomo and others, they invest in the U.S. capital markets, they invest in U.S. CLOs. Japanese investors invest in U.S. equities. But if you look at the Japanese yen, in the first week of July, we are at 162, and the Japanese yen in a period of less than 3 weeks has really crashed. It's actually strengthened So that if you look at it
Yeah.
inverted, it looks like it crashed, but actually strengthened from 162 to 146.
Yeah.
And as a result, of the anticipation of this rate hike, it's really taken traders off sides. And as they've shrunk their books, it's becoming more risky to borrow because the cost of capital is no longer zero in Japan. They have to unwind those bets and sell assets. So I think it's a big part of it. But when that selling starts to happen, it also causes fear across the market, right? So then you have hedge funds selling, you have CTAs managing their books because they're levered, managed future. They mostly trade through managed futures, and then you have retail, right? Some of them, a number of retail accounts, exclusively trade call options, and when you have a 5% move, it can completely wipe you out. So while margin debt relative to market cap is not at peak levels and is not a cause for concern, what is a cause for concern is that, in some of these high flying stocks like Tesla, Nvidia, there's often more option notional that trades every day than the actual stock. And I think, that also contributed to, the sharp move in equities lower at the end of last week.
Could we use the yen versus USD as a leading indicator for stocks now?
I think it's something that you should closely monitor. My view is that, the Japanese economy is still, it's still relatively weak. Asia is weak. I don't expect, the yen to snap back, to where it was pre-COVID, which was 110 to the dollar, between 100 and 110 to the dollar. But, could the Japanese yen strengthen, below? Could it go to 140 to the dollar, from where it was to 162? Could it go to 130? It's very possible. And that, I think, would cause a bigger unwind and, could negatively impact U.S. assets at the same point in time, where U.S. economic data is slowing. And to give it, the actual data that I think scared people last week, it was literally the day after the Fed meeting, we had some ISM data come out, and there was an employment subindex of the ISM manufacturing report that came out. And while the U.S. is not a manufacturing economy, it was the first labor data that had come out after Jay Powell spoke and said he wasn't cutting rates immediately. And that data, it really scared the market. It came in at 43. So when it comes to ISM and PMI, anything under 50 indicates a contraction. So when that data came in at 43 versus expectations of 49, that was a big drop in manager perception of strength in the manufacturing economy, because it's essentially a survey data point. And I think it scared a lot of people. And if you read the actual report, I do have a snippet of the report I'll read to you, because they actually publish a full report. Most people tend to think it's just a data point. But let me just pull that up for you 1 second.
Yeah, and while you're doing that, I'm going to read this tweet that you made not too long ago. You said Berkshire Hathaway cutting stake in Apple to raise cash to a record high of $277 billion.
That's a very big thing. He cut his, Warren Buffett, Berkshire Hathaway, their biggest position over the last few years has been Apple. Part of it has just been because of the appreciation of the name. Apple's also doing, almost a $90 billion share buyback right now, which is supporting the stock price. They reported earnings. Numbers were pretty decent, up 5%. But the company has struggled. Its unit sales have been falling for the last couple of years, especially in China. It's really relying on its partnership with ChatGPT to drive sales. But Warren Buffett cut its stake, I believe, in half, and he has raised almost $277 billion of cash. It's the highest levels of cash that Berkshire Hathaway has ever had. I have to go back and calculate, cash versus market cap, and I'll get back to you with that. But it is an absolute war chest now of cash, and I think on Monday that was going to scare a lot of people, because that data came out after the close.
Yeah.
Yeah.
So you tweeted this just today on Saturday as we're speaking on the 3rd of August. And it's interesting because Berkshire Hathaway already reported a record cash stash in Q1.
Last quarter.
Yeah, yes. In Q1. And now, like you said, they're adding to it. So this begs the question, like you posed in your tweet, is this the top in stocks? Because you wrote that with some suggesting he may be calling a top in tech stocks. Where do you stand on this?
Yeah, so I think when it comes to macro markets, I try not to be a macro guy. I made most of my money in single security selection. Yeah. But what I will say is that, we are getting a lot more cautious on the U.S. economy, and I frankly think that tech stocks have been overvalued versus the rest of the market for the last few months, and it's been very obvious to people. I'll just give you an idea. The forward PE ratio on tech stocks has been close to 35 times versus 21 times forward for the overall index, and part of it has been due to the fact that 2/3 of the earnings growth this year has been expected to come from just 5 mega cap tech names. But as that earnings growth slows, as we've seen with the number of companies that have already reported, Amazon reported great numbers, but its outlook missed by just 1% on revenue growth, and the stock was down 11% on Friday. That tells you that there's a lot of growth expectation priced into the market. And if companies, you don't even need to have a recession. If companies just ratchet down their growth expectations by 1, 2, 3% on the top line, it can take the NASDAQ down another 10, 15%.
Sorry, what can the trigger?
So if revenue and earnings growth expectations for the top names in the NASDAQ and the S&P 500 come down by just 1 to 3%, okay, it can, because their multiples are so high, it can pull these names down materially. And I'll just give you an example. Even despite this recent sell-off, tech names are still incredibly expensive in the market. So I'll just give you some examples of of top names in the market. Let me just pull up my my tech tracker. A lot of data up here in preparation of this call. But before we actually get there, I pulled up the ISM report, and I wanted to share some insights from that report. So, number one, what manufacturing? These are manufacturing respondents to this ISM survey. Business is relatively flat. This came from chemical products survey within the ISM. Demand continues to soften into the second half of the year. Supply chain pipelines and inventories remain full, which indicates that pricing is going to go down. That's actually positive for inflation. Geopolitical issues between China and Taiwan are making manufacturing companies be cautious going into the end of the year. The consumer behavior is changing more than normal as consumers are, their budgets are strapped. There's usually a seasonal reduction in business over the summer, but what they're seeing is a bigger pull down than they were anticipating. Customer orders are coming below forecast. Consumers are pulling back on food, beverage, and tobacco spending. Availability of products is high, and inventories are rising, especially in computer and electronics, which means that prices could fall in those categories. This comes from Machinery CEO. The economy is slowing down significantly. We are hoping for an increase in customer demand, but we might have to make organizational changes, which means firing, which leads into that employment statistic of 43 versus 49. I'll send you this if you want to post it.
Please.
The businesses are experiencing the sharpest decline in order levels in a year. This comes from a fabricated metal products manufacturer. This last month was the first month that we had negative net income. We are well below our budget target for June. So he's talking about June, as this came out in July. Business is slowing. This comes from an electric equipment appliances manufacturer. There's a non-metallic mineral products. We're almost at the end of this, saying that some markets are unusually showing weakness. Our sales for July and August are slowing. This comes from a U.S. textile mill company. And the last one, elevated interest rates and financing costs have dampened the demand for residential investment. This comes from a wood products company. So we've seen, several different types of businesses, from consumer products to electronics to housing, have reported weaker than estimated end market demand and have said that they have to cut costs, which means fire people, in this ISM report. So people can look at the data point, but I think the big hedge fund managers and institutions that actually got that report, once you read through the bullet points, almost every single one was negative, and you usually see a mix of positive and negative.
Okay, you said earlier that we could see more volatility ahead. Now, let's talk about the assumptions behind that statement. First of all, we're looking at the economy. You're pointing out to ISM report that indicates a slowdown in growth. Also, this past Friday, we saw the unemployment rate tick up to 4.3%.
Yeah, I think
So
you're
the
talking about that.
volatility, yes, yeah, so the volatility you're talking about is predicated on a slowing economy.
The volatility is predicated on a slowing economy. So the key thing to note here is that the market is now fighting between being optimistic due to potential rate cuts in 2025 versus a potential decline in earnings growth. And what we've seen is the market was rallying all throughout the year because of an expectation of cutting rates. If you recall, in January, the market had priced in 7 rate cuts just for this year. And we're already in August now. We haven't had any rate cuts, right? So the market went from 7 rate cuts basically to 0. And now for the next 18 months, the market is again priced in 155 basis points of cuts. So we're back at 6 cuts for between now and the end of 25. So companies that rely on borrowing, that rely on leverage, which is roughly half of the Russell 2000 index, has floating rate debt, and 40% of that market has negative EBIT. Small cap stocks are actually more exposed to high rates, and it's a push and pull. If the economy weakens, those companies are going to get hit the most because they have higher financing costs. They're suffering from higher prices. They aren't able to push those prices on to consumers anymore. That's why you saw the Russell pull back its entire summer rally in 2 days. Tech stocks are also sensitive to rates, but they're sensitive because their valuations are predicated. And when you construct a valuation, the risk-free rate, the discount rate, is one of the big drivers of your assumptions. And they're sensitive to growth, but they also should benefit if we cut rates. So it's a multivariate equation. But the easiest way to think about it is, in this type of environment where there's uncertainty about growth slowing down, the sectors that should do well when rates are moving down are the defensive sectors where you can more so predict revenue. So I'm talking about utility stocks with government contracts, companies that have addictive products like tobacco companies like British American Tobacco. That stock's up 20% through all this volatility, has paid a 9% dividend. Preferred stocks. We have a huge portfolio of preferred stocks, companies that invest in agency mortgage-backed securities, using cheap leverage, infrastructure, pipeline companies. And we have a portfolio of names that pay for anything from 6% dividends to we recently found an AI data center name with a 15% dividend that basically actually rallied through the end of the last week, and we built a relatively large position in our educational portfolio. So there are always ways to make money. When you have days where correlation goes to 1, it's hard to find those names. But over long periods of time, these types of moves are very normal. Going from defensive to cyclical back to defensive, going from growth to income. That's why it's important to have a diversified portfolio. You can see these names move in real time and allocate more to the ones that you think will do well in the near and medium term, and take profits in names that you think are going to pull back. And that's what Warren Buffett's doing with his portfolio. Right now, he's pulling back on his main growth name, because the other names he owns are Bank of America and older industry names. He's actually trimmed Bank of America as well last month. That was publicly shared. So he's trimming names in both value and growth.
You mentioned the expectations for Fed cuts in September and beyond. First of all, the markets, the stock markets and the bond markets in particular, they factored in, I think, up to 6 cuts in January 2024. And as
7.
you know, the expectation 7, 6, 7, the expectations shifted. Why did everyone get it, I would say, wrong in January and then later shifted the expectations? And I'm bringing it back to today.
Yeah, it was all about inflation. We had inflation come down in 2023, and we had a slight resurgence due to the Middle East conflict and OPEC cuts. Oil was expected to rally. And also in December of last year, there was an expectation that President Xi in China was going to do a big stimulus and that would push up commodity prices. That has not yet played out. And I think there's some strategy behind Xi. The Chinese are thinking 5 years in advance. In the US, we think about quarters, very short term oriented. But overseas, they plan. And I think what's happening is, in my opinion, and I could always be wrong, I think Xi's waiting for the November election because he's not sure what the tariff impact is going to be on the country. And he's held back on stimulus. So what you've seen is that inflation expectations rose in the beginning of the year, and it caused Federal Reserve's Powell to be very cautious. And now it's very obvious that prices are falling all over the world. You're seeing it in China, you're seeing it in Europe, you're seeing it in the US. You see it across all categories: goods, services, real estate. The only thing that has been going up very sharply has been insurance. Property insurance and car insurance rates have gone up. And that's actually one of the reasons why inflation looked higher than it was in prior years, because insurance has been going up so much in the US.
So I asked this because I'm looking at the CME Fed Watch tool right now, and it's basically priced in that each of the subsequent Fed meetings, September, November, and December, will see at least one cut per meeting. So that's
correct.
3 cuts.
There are 3 cuts priced in for this year, and
right.
155 basis points until the end of 25.
What makes you think that the markets aren't wrong again this time?
I think what I am seeing is that there is weak data coming from the global economy, from most developed markets, and that inflation is now low enough. We're at a 2 handle for PCE. I think inflation is low enough for the Fed to cut. And if you actually go through, the Fed minutes, I have a thread. I think it's like a 20-part thread on the Fed minutes, which is freely available on my Twitter timeline. I think Powell clearly stated that inflation is no longer his top priority, that he has a balanced view on unemployment and inflation. And he is basically looking at unemployment. And if you were to see unemployment, my interpretation was over 4.5%, and we just hit 4.3, he would be more than ready to cut. There's a rule called the Somm rule, and it's actually very funny because he actually poo-pooed Claudius Somm is an economist.
Yes.
Essentially created the rule, and we actually breached the Somm rule last week. So for people who don't know what the Somm rule is, and then we'll get into some cooler, more interesting single name ideas.
Yeah.
Basically, it's a recession signal, and it basically states that if the jobless rate, based on a 3-month moving average, is 0.5% above its lowest point over a trailing period, that 9 times out of 10, that signal is a recession. And we are at that point. We are at 3.6% joblessness about a year ago. Mm-hmm. And we were at 4.1% last month, and we just ticked to 4.3%, right? So that's a 70 basis points, 0.7% increase in the unemployment rate. And we are officially, according to the Somm rule, in a recession. So when someone asked Powell that question during the meeting last Wednesday, he denied that rule had much merit, because he said this economic cycle is a lot noisier. There are a lot of other considerations. But in my opinion, I think there's some truth to that. We may not be in any type of a deep recession, but I do think we're entering a slower period of growth. Okay. And one way you can actually track that is you can actually go on the Atlanta Fed GDP Now, and they provide like a weekly update on what the Atlanta Fed's expectations are for GDP growth in the prior quarter.
Are you saying the Somm rule is broken now? Because if we're not going to be in a recession...
Powell is saying the Somm rule is broken. Mm-hmm. I am saying that it isn't fully broken. I think there's still some truth to it. But I think there might just be a weaker correlation.
I see. Let's segue into some special situations, some single stock ideas, Jay.
Absolutely. So there have been a lot of themes that we have invested in that have done really well this year. We were actually early to this AI theme. We were actually one of the first people to say that a Magnetar was setting up a vehicle to buy H100 chips because demand was so high from NVIDIA, from big tech names, from sovereign nations. So we were long a number of names like NVIDIA and ASML, which is one of the biggest lithography um, machine manufacturers in the world that produce chips. Early on, we completely sold out of our position about a month ago, and it was just fortunate timing. I talked about that Computex event, and I just realized there's too much euphoria in the space. And I also thought that the forward earnings estimates where you were getting close to 40, 50 times, with respect to an earnings multiple, and I just didn't think the growth was worth paying that type of a multiple. We're also long a number of the GLP-1 names, including Lilly and Novo Nordisk, because there's a huge demand. I think there still is a massive demand. I think it'll grow to 100 billion by the end of this decade for weight loss drugs. I've personally seen a lot of my friends lose the weight, friends who are older, who have diabetes, who have liver issues, who have, that are obese and have heart issues that have really benefited from this medication. So, I've been long and strong in Novo Nordisk. We sold out of our Lilly. We've also been long a name that could be a disruptor called Viking Therapeutics. It has a drug that is equally effective. The company produces, historically produced drugs, therapeutics for patients suffering from metabolic and endocrine disorders. That's a much smaller company at 5.8 billion market cap, but we think that if it is able to come out with a new drug that can compete with the GLP-1s on the market right now, with lower muscle mass loss and less side effects, that it could be a disruptor in the space, and it's more speculative. Against that, we've shorted a company called Hims, and Hims is actually a decent business. It is a company that is called Hims and Hers Products. It is a business that is essentially a marketing app that allows you to buy, hair loss medication, generic medication. It allows you to buy drugs like Cialis for men's performance in bed. It also allows you to buy GLP-1 drugs that are manufactured by compound pharmacies that essentially, after speaking with the doctor on the app, it's really just a messaging system. I downloaded it myself. It allows you to buy these drugs almost instantaneously and ship them to your home. Now, I do think that the stock is a short and actually is down over 20% since we initiated our short, because one of the reasons why the stock has gone from $5 a share to $25 a share, it ended the Friday at 17.58, is because there's euphoria associated with the fact that it was selling these GLP-1 drugs. It was only able to do so because of shortages. There just hasn't been enough manufacturing capacity, to manufacture and send out these drugs. They're not in pill form, so they're more expensive to manufacture and distribute. And as a result, this company has benefited from those tailwinds. And I think that Eli Lilly came out last week and said, we have enough manufacturing capacity. By 2025, there will be no shortage of GLP-1 drugs. And if that revenue stream goes away, I think the stock could go down 50%. That's my opinion.
Wow.
I reserve the right to be wrong. For people who are long, I hope I am wrong, but I do think that it's a good hedge because we are long the GLP-1 trade, and I think it's a good hedge to our portfolio. That's more on the healthcare side. Those are more, hedged, more speculative equity trades. We're also doing a lot in income. Most people don't focus on the hybrid market in the U.S. is a $1.1 trillion market. There are hundreds of issuers, from banks to insurance companies to master limited partnerships, energy, infrastructure, power companies, and REITs and BDCs that actually issue baby bonds and prefs that retailers can actually buy. They're 25 par. And they come in different flavors. They come in the form of sometimes secured debt, sometimes unsecured debt, sometimes preferreds, which are senior to equity. And because interest rates are so high, a number of the new issues that I've seen, are yielding close to 10%. And a number of them have floating rates. They go from fixed to float. Some of them are yielding 12 to 16%. So we build a robust income portfolio, and we take the dividends that come in from that portfolio, and we invest in, names like British American Tobacco, the GLP-1 names, the AI names. I've always been more value oriented, and I've been, I tend to have a big income part of my portfolio. We have an allocation to T-bills. We have an allocation to AAA CLOs through the JAAA product, which we're now rotating. more into mortgage-backed securities products. One of the big themes in our income portfolio is going from floating rate to fixed. And I think that Jeff Gundlach echoed our strategy. He's going long double B high yield because it's higher quality, high yield. We think that, the opportunity was earlier this year, shifting some of your portfolio into longer duration. So we started with 2 to 5 year duration treasuries and higher quality credit. And then we moved into now REIT preferreds that we've had positions in over the past 2 years, but we were sizing some of our positions in the common as well. Some of these names, pay 16% dividends, and they're only invested in U.S. government mortgage-backed securities. If rates were to go down, you could see some of those MBS spreads compress, and could easily generate 20% plus returns, even with a weaker U.S. economy. So there's quite a lot to do from a market perspective when it comes to merger arbitrage. One of the ideas that we recently just hit it out of the park last week with, the stock was up despite the market being down 2 days in a row, is a company called RCM. And RCM is a very underfollowed mid-cap name. The top holders are New Mountain Capital and Towerbrook Partners. About 60% of the float was held by those two funds. It's a revenue management company. And the reason, I think it was underfollowed was, it's a $6 billion company, market cap. It wasn't, a high flyer. The stock had underperformed for many years. There is a short report, I won't mention who published it, a 95-page short report that, about the sustainability of the business model and the customer mix that resulted in the stock essentially falling from $30 a share all the way to $5 a share. But the company has a very strong customer base. It's one of the 3 revenue cycle management companies that serves the healthcare sector in the U.S. So it has a very defensive customer base. And essentially, these 2 large equity holders were in a bidding war to buy the company. So essentially, in February of 2024, there was a bid announced for the business. That bid was pulled. There was then a sharp sell-off of the stock that fell. The stock fell to almost $10 a share. We started accumulating a position. We mentioned it on Twitter. On July 2nd, there's a tweet you can go back and see. We started doing research on that day. We bought the stock, and the reason why we bought it is that the other shareholder was still involved, still wanted to buy the company. They put a $13.25 bid on the shares. It was obvious that there was a third buyer coming in to buy the stock, and last week they bid $14.30. So this is a stock that went from a 10 handle to closed at $14.05 at Friday's close. It's almost 30% return in less than a month. And there are opportunities like that in the special sits world that show up all the time. We keep track of almost 40 merger arb spreads. Another one is GAN. It's being acquired by Sega Sammy. Essentially, it's a sports. It's in the sports betting and gambling market. And this stock fell to below 120 back in April. We started loading it as low as 118. It's almost at 160 now. It has a 197 cash bid. For the name, we were also involved in Paramount, which has been a bidding war between the son of Larry Ellison, the founder of Oracle, and several other potential bidders, including the founder of Allen Media Group. And that name, we were buying again when we wait for these positions to get distressed and for the probability of the merger completion to fall to a point where it's not pricing in a meaningful probability of a close, and we look at the business fundamentals. We try to avoid really, risky and crappy businesses, and we say, okay, this is a business that could be taken out. The underlying business isn't terrible, and so we were buying Paramount, in the 9s, and we kept adding until we got to 1039. Then we got the new bid for the business, and one of the reasons why the business should have been bought before is that Sherry Redstone, Paramount has 2 share classes, owns the voting shares. And so she owns a business called National Amusements, and she has a bunch of underperforming movie theaters that have been, creating losses since COVID that she's funding and taking losses on. And when Paramount cut its common dividend, she no longer had that dividend coming into her portfolio. She also owes 180 million of back taxes from her father, who passed away and bequeathed her with the voting shares. So we knew that she would have to sell, that she was a forced seller. So that was a really interesting merger arbitrage play. All of these names I'm sharing with you have played out in the last 2 months, but we've had almost 15 or 16 of these opportunities just this year that we've been in and out of, like U.S. Steel. So there's frankly a lot to do in the special sits world, and I do think it's an area in the financial media community that is not really focused on, and I think that retail could benefit from a number of the hedge fund strategies that I used to employ at Goldman.
Yeah, we'll definitely keep tabs on that. So thank you for sharing this. And before we close off, I want to ask you about China. You brought up China briefly earlier today. So second quarter GDP rose by 4.7%, which was lower than the expected 5.1%. So it is moving at a slower pace than the consensus expectation. What does this mean for, I guess, domestic markets in the U.S.?
Yeah, absolutely. So the biggest question when it comes to the upcoming presidency is, if Trump were elected, would he raise 60% tariffs on Chinese goods and 10% even on our allies? And I think that while Trump would do a lot of good things for the U.S. economy when it comes to cutting regulation, which is positive for businesses, cutting government spending, maybe keeping taxes lower or cutting taxes. Some of the things that I think he's proposed are unsustainable. For example, we have a large budget deficit, and some of the policies, would frankly, be very challenging to put forth. And with tariffs, while I am for protecting our IP, 100% agree that we should protect our IP from Chinese interests. I do think that raising tariffs, when you raise tariffs, the way that the transaction actually works is U.S. companies are going to pay more for goods. It's inflationary, and then that hurts foreign manufacturers and sellers because it forces them to take some of that hit into lower prices, and it forces them to find other customers to sell those products to. But I do think that Chinese growth has slowed down to almost 4.5%. Expectations in December last year were for 5 to 6% growth. You have 25% youth unemployment, and you have a real estate overhang that, if you actually do the math, because Chinese population peaked in 2018, adult population, that you have a real estate cliff that could take 10 years to swap up, to mop up that inventory. So you have a huge overhang of real estate, and because consumers were locked into their homes during COVID, speaking with a friend in Hong Kong, and he was basically saying that there's a rebellion. It's called the savings rebellion in China, where millennials are saving because the government didn't support them at all. And people in Europe and US may not understand this, but in Europe and the US, when we do stimulus, it tends to be consumer-focused stimulus. We hand out money to people so they can buy goods, pay for their food, pay for their rent, pay for their utilities. In the US and Europe, when they had the Ukrainian crisis, they were subsidizing people's electricity bills and heating bills. In the US, when we had COVID, they increased the SNAPS benefit program to give people food. They had a mortgage and rent moratorium. What happened in China was nothing of the sort. Most of the stimulus in China tends to be focused on the SOEs, the state-owned enterprise, and it tends to be supply-driven. It's never demand-driven. So the market realized, and people are realizing in China, that the government isn't really helping them directly, and their savings rates need to go up. And that's resulted in a big decline in demand for luxury goods. We've seen a number of luxury companies that have reported over the last years. There's actually a big merger arb named Capri, and it's one of the biggest providers of luxury handbags in the world. It's currently under a bid, and its earnings haven't been that great because of demand overseas. So I personally think that Xi has been waiting to unleash a bigger stimulus program, because if Trump were to become president, if you saw a 60% tariff against China, which is the worst case scenario, they would go to a recession. It wouldn't be 4.5% growth. It would be 2% growth. And in China, you need at least 4% growth to sustain employment. because the economy is structured differently. Half the growth in China is driven by real estate and manufacturing in Guangdong and
Yeah.
other areas.
And that would be also inflationary for the US, would it not?
It would be inflationary for the US, but I think that certain parts of the economy are slowing down. So you know, the timing would kind of work out that I don't think we would need to raise rates or anything drastic would happen in terms of the Fed's view on policy in the economy, but it would keep prices high. Right now, the biggest declines we've seen in inflation are on goods, especially goods coming from overseas as the dollar has been strong. But we could see goods inflation come back a bit in 2025 under that scenario.
And a Harris presidency, potentially a Harris presidency, how would that change in terms of our foreign policy objectives with China?
Yeah, absolutely. I think Harris would be more of the same. I think she would keep the current tariffs that we have. Um, and, I think she would take up, first of all, I don't even know if they're Biden's policies because we've seen that he has trouble even articulating himself.
I
But
understand. Yeah.
his administration's policies, I think, would be carried forward. I think in the case of Trump, if you read Trump's agenda, 47 proposals, our team did an analysis of the 220 executive orders from his first term, and what we saw is that Trump there are 10 themes I'll go through really quickly. Number one, Trump would be a game changer for immigration and deportation. I think Trump will terminate benefits for undocumented immigrants. He'll intensify deportation detention efforts, which would be good for private prisons. He would cut public housing, food stamps, health insurance, and citizenships for children of undocumented immigrants, and it would affect companies all over the U.S. Everything from Deere, FMC, AGCO, but also names like DoorDash, Yum, would face negative impacts on trade and tariffs. Like you said, Trump is expected to align U.S. tariffs with those of trading partners. Right now, his view is that European countries are underpaying for their defense. So he plans to add a 10% tariffs for our allies and 60% on China. That'd be positive for U.S. steel companies. It would be negative for companies that rely on global earnings. Deregulation. I think one of the areas where Trump can actually help the U.S. economy is through deregulation, and that would be good for financial services firms, tobacco firms. It would be good for all the mergers that we cover because it would involve getting rid of Lena Khan, who's a big antitrust regulator. She's very anti-Amazon, anti-Microsoft, anti-basically every company that wants to merge because she wants to avoid consolidation. Energy policy. I actually think Trump would result in lower energy prices because he wants to push more drilling on U.S. land. So people who like energy will have to understand he's good for volume growth, he's negative for price. Whereas I think the ESG rules that prior Democratic administrations have put forward would be extended, and that would actually result in higher energy prices and less drilling. So that's kind of counterintuitive. I think that Trump would also cut the Inflation Reduction Act, which I don't think that obviously Harris would do. And it's the new Elon Musk Trump affiliation, I think, is very strange in my view, because I think Trump wants to cut electric vehicle subsidies. So we'll see how that would play out. When it comes to drug pricing, this administration has been pushing companies to cut prices, everyone from Merck to Regeneron, Bristol Myers Squibb, Teva, Vertex Pharmaceuticals. I think that Trump would be less. He would be, I think, more amiable to big pharma, whereas this administration is not. Foreign policy with Russia, I think Trump has stated that he could end the Russian war in a day. That's not possible, but I do think that in the U.S. there's a lot of frustration on hundreds of billions of dollars being sent to Ukraine. I think he would at least try to create a diplomatic resolution. Government budget. This, I think, both Harris and Trump would actually increase our budget deficit. Harris by forgiving student loans and giving out free money to win votes, and I think Trump, frankly, by cutting taxes because this 35 trillion of debt we have is not going to just go away if you're cutting taxes and increasing spending. So in in that scenario, I actually think gold prices will go up, and perhaps even Bitcoin prices over the next 3 years as interest rates come down and our budget deficit in the U.S. grows. At 120% debt to GDP, we used to make fun of Europe and Japan. We're going in that exact same direction with our debt load. It's unbelievable.
Okay.
Education authority. I think Trump wants to cut funding for the Department of Education and give that responsibility to state, and that would benefit companies like Instructure Holdings, Power School Holdings. It would also affect companies like Navient, SoFi, and Avantor. And finally, with the federal workforce and free speech, I think that I think that Trump wants to cut a number of the federal jobs, and he wants to give more to the states. And on free speech, he says, Trump plans to ban censorship of speech, and he wants to promote freedom of speech. So that could actually negatively impact Alphabet, Google, and Meta, which are known to effectively censor. It would be beneficial for Musk's platform, which is Twitter. So there's frankly a lot. I can go into each one of these topics more, maybe on another call.
Yeah.
But there's a lot of work we've done on thematic trades associated with different political appointments, depending on how the November election goes. What happens when a president enters office is that he or she will appoint their own cabinet. And those members of cabinet will have discretion and authority for implementing policy, bringing forward proposals that later go to Congress. But they also have some, they have power to do things even without Congress. So it will definitely impact the market. And it's a very critical time because we have private equity. Global private equity is $4.5 trillion of cash. They're waiting to see who becomes president to really start to deploy. We have China, President Xi waiting to see what tariffs look like so that he can unleash his stimulus. We have, huge AI bubble, and we have to see, one of the themes that I failed to mention on the call is we've been very long power companies, names like, VST, which is one of the Vistra Corp, which is one of the largest power generators that could benefit from data centers, which are hugely power consumptive. So, essentially cryptocurrency miners, data centers, and AI, and the industrialization of the U.S., bringing more manufacturing and insourcing to the U.S., are three drivers of power demand. According to B of A, they could add additional 3% to power demand through 2030. So if you look at the charts of like Vistra and its peers, that has been a great trade in the recent pullback. We're buyers of that. We're buyers of that pullback. And some of these names also pay some healthy dividends. So, I could go on and on about political, impacts on various sectors, but I know that we've reached the end of our time.
That's okay.
We can always jump on another call to discuss, various special situations, and we're always doing research on macro industry dynamics and single names. So I appreciate your time today.
Well, I appreciate your time. Where can we learn more from these special situations, Jay?
Absolutely. So we cover a broad list. We have sector coverage, but we also cover 400 closed-end funds, closed-end fund arbitrage. We have a list of 700 prefs and baby bonds that retailers can do their own research on and buy. We cover over 600 single name stocks. We have about 100 models on our website that you can purchase. It's all at specialsitsresearch.com. We have a team of about 9 people, across the globe that they're doing research each day on various different opportunities. We also have a Discord group, which is essentially like a chat room with 40 channels. And I'll just open it up right now to give you some of the channels. There's some that you probably never heard of, but we have a channel that focuses on Dutch tenders, odd lot Dutch tenders, where if you buy less than 100 shares and a company buys back their shares, you get much bigger premium than other shareholders. We have a channel that focuses on banks. We have a bankruptcy channel. We have a BDC income channel. We have a behavioral bias and technicals channel. We have a capital structure arbitrage channel where we go long prefs and short stocks on a delta to make an asymmetric return profile. We have our closed-end funds, commercial real estate, CTA flow tracking channel, energy, fixed income, gold and gold miner stocks, copper, growth stocks. We have a high yield savings account channel for people who are more conservative, litigation arbitrage that looks at lawsuits and how to benefit from them, merger arbitrage, MLP, and tax benefiting products like REITs. We have an options implied volatility channel for people who like selling puts for income. We have an overvalued companies channel, which is a nice way to say shorts.
Yeah.
We have a SPACs and IPOs channel that tracks all the IPOs coming in, spinoffs. We recently have a channel that focuses on uranium, 13D activism. We always had a value stocks channel, but we do a call every Sunday at 3:30 p.m. and we have recordings. You can actually track what we're doing. Listen to our recordings from years ago, and we do a 2-hour call every week that everyone kind of logs into on our Discord. And then at 4 a.m. every day, we have people coming in to share their ideas. Everyone from former portfolio managers, hedge fund managers, some current hedge fund managers that have pseudonyms that talk in our chats. And we have private equity guys, real estate guys, tech guys, and it's a really good community that we built since 2021 that share their ideas. And sometimes I learn from them. So we have some doctors in the space. And I was late to the GLP-1 trade. I learned a lot from them about the benefits of those drugs and who are the big players and what the TAM was, what the earnings growth could be for some of the companies, what their profiles were. So there's a lot that I learned from the community now. And I think that there's a lot that people could learn. It's very affordable. It's $45 for the community, $20 for the email list. And again, you're on the same email list with big funds that are paying $10,000 a month to get the same research. So it's to the benefit of, individuals to empower themselves. I personally subscribe to over 100 different products because I'm always reading and finding ideas. So you're getting a big funnel of ideas that you can choose from and do your own research on. And the idea is to democratize investment research and empower people to have the ability to invest in the ways of hedge funds, which is looking for asymmetric return profiles, and looking for names that have 3-to-1 up down type return profiles and support that with a lower risk income profile. The goal is not to generate high returns. We don't buy call options. We don't use leverage. We avoid all leverage ETF products. We don't day trade. The idea is medium term allocation. And if we do find an arbitrage opportunity that plays out in a week, that's great. But the goal is medium-term allocation and idea generation.
Jay, thank you very much. We'll put the links in the description below. I'll speak to you again soon. Thank you.
Thank you. Take care.
And thank you for watching. Don't forget to like and subscribe.